Reaction now with Steve Brice. He's Chief Investment Officer at Standard Chartered Wealth Management. He joins us live from Singapore. Steve, great to have you on today. Hardly joining from Abu Dhabi. Steve, let's just begin by getting your reaction to what you've just heard from Janet Yellen there. And also, secondly, no shortage of key risk events on the horizon this week. The FOMC, US GDP, earnings on tap as well. What do you think is the most important for the direction of stocks?
I think it's obviously going to be the FOMC meeting. I mean, the technical recession that may be confirmed this week is just that. It's technical. We do still have a very strong labour market. Retail sales last week was quite strong, which was nice to see. And there's some tentative sign that maybe consumer confidence is finding a floor here. So there are some positive signs out there. But I think what's going to be key is not the 75 basis points, which looks a done deal to us. Is how they communicate the outlook from there. Obviously, inflation is still relatively high. On one level, you could say they've already met the objective from an inflation expectations perspective, but short-term inflation is still way too high for politicians, and that's likely to be very high on the agenda at the FOMC meeting this week. So what they indicate about the future for the forthcoming meetings, I think is going to be pretty important.
Indeed. So FOMC seems to be baked in right now with that hike in play. But of course, the communication, the forward guidance is going to be really closely watched. Steve, at the same time, we're also expecting to hear more from companies this week reporting earnings. And look, investors have been bracing for a pretty disappointing quarter, but it seems as if they're more than happy to brush some of that disappointment aside. Why do you think that's the case?
Well, I guess it's partially due to the fact that equity markets have already fallen quite significantly, right? So we know that sentiment has been very poor after the sell-off in the first half of the year. And I think that does in some way help people maybe look for the silver lining when it comes to earnings. I think what's interesting is while though, we have seen the positive surprise for Q2 earnings so far, and that's normally the case, of course, we usually get that. We're still seeing the full year earnings expectations for both this year and next year being downgraded. So from that perspective, it isn't Armageddon. We do expect the corporate earnings to continue to grow in the coming months. But I think there is still the risk that we could see another wave of selling in equity markets before we form a real base. So we raised our allocation to bonds in recent times. Obviously, that's worked really well with bond yields coming off. We'd be basically looking for any spike in yields on any inflation disappointment to add to bond positions going forward rather than adding to equities at this stage.
Steve, it's Hadley in Abu Dhabi. Okay, this is a bit of a two-parter. Might be a little outside your wheelhouse, but I think it's important. November 8th is the date of the US midterm elections. And at the end of the day, Janet Yellen may be saying one thing. She doesn't think it leads to recession. But at the same time, the World Bank has said just a few weeks ago that they think that the Ukraine war may lead to a global recession. It's difficult to pick apart the pieces at this point. But how difficult do you think that the current situation economically in the United States is going to be for those who are heading into elections in November? I mean, are we talking about the Democrats being out and the Republicans sweeping the House and Senate? What does this look like to you? Because there's so much uncertainty.
Yeah, I mean, it is really difficult to project that far forward almost. I know it's not that far away, but our sense is, look, a recession is not quite a central scenario, but we attach a 40% probability of recession in the coming 12 months in the US, right? So clearly, if you're looking at the indicators, more are flashing red. So we track about 14 indicators from a recession perspective. 5 of them are flashing red. That's up from 2 just 6 weeks ago. And most of the trending data is actually negative, of course, and we saw that in the housing data last week as well. So our perspective is that the risks are pretty elevated. Obviously, the polls are already been shifting against the Democrats quite significantly already. So it looks like it's going to be very difficult for them to hold on to the control of the government. And therefore, we're probably going to have a divided, at best divided, but maybe we could even have the Congress on one side, the presidency on another side. So, that's probably the most likely outcome at this stage. And if obviously any weakening in the economic data from here will just reinforce that outlook.